Welcome viewers. Today, we are meeting a wonderful man from the mutual fund industry. He has been instrumental, in many of the, things in the past in the industry. So, and it is from Nippon Mutual Fund. So he is the CIO, Chief Investment Officer of Equities in Nippon Mutual Fund. Nippon Mutual Fund, as of today, manages more than 280,000 crores of assets, out of which equity alone is 103,000 crores and above. So Nippon AMC Asset Management Company is a publicly listed and stocks are traded both in NSE and BSE. It has many flagship schemes to its credit. Earlier, Nippon Mutual Fund was known as Reliance Mutual Fund. Subsequently, the Japanese Nippon Life took over Nippon Mutual Fund, and they are the majority shareholders now. Mr. Manish Gunwani is the CIO for all equity investments, which is more than 103,000 crores. He personally manages Nippon Growth Fund, earlier which was called Reliance Growth Fund, and one of the flagship schemes. And I mean, we might have seen a video earlier, 10 rupees becoming more than 2,000 rupees. So it is 200 times returns. And Nippon BAF also he is managed by Manish, in addition to overseeing all the equity schemes. Earlier to this, he was with ICICI Mutual Fund, and I know him from his ICICI Mutual Fund days. And he was instrumental in a few large schemes there, and which were a hit, I would say, a big success in the industry. And Manish graduated from IIT Chennai, from here, Tamil Nadu, with a BTech degree and a postgraduate diploma or MBA from IIM Bangalore. Now, namaste, Manish. Welcome.
Thank you. Namaste to everyone.
Yeah. Manish, just let us get into the questions straightly. Some of the questions, and market being volatile, and Russian war, Russia-Ukraine war going on. Now we were all happy that Corona is over. And now markets will go up and economy will pick up, everything, all those things. But unfortunately, this uncertainty, we are always facing something, nothing but change is true. Similarly, now we are into this geopolitical situation. And what is your thoughts on this uncertainty and how we will be overcoming this? And have you seen this kind of war earlier? Some of your thoughts on this.
No, it is very interesting time. May not be very happy time, but it is interesting nevertheless. You're correct. I think somehow in the last 10 years, unlike that 2002 to 2010, we had one very big bull run in the economy. Last 10 years, what we are seeing is every 2 years, there is one disturbance or the other. So as you said, change is perpetual. So what in 2011 we had European sovereign crisis. 2013 we had taper tantrum. 2015 we had yuan devaluation. 2018 we had US-China trade war and NBFC crisis. 2020 we had COVID, and now 2022 has started with this war. Unfortunately, India probably impacted a bit more because we are importers of energy. So especially oil and the related commodities, whether it is agri commodities like sunflower, etc., or steel or coal, etc. Everything has gone up quite a lot. And India, since it is a big importer of these commodities, we have to admit that the fundamentals of Indian economy are being challenged. There is no doubt at all. It will not be wise to shirk this away and say everything is fine. It is a big challenge. Now, after about 1.5 to 2 years of COVID, one was hoping that the pent-up demand and the fact that global growth is good, so exports will do well, and that positive remains. but definitely it is now countered by this increase in oil prices and other commodity prices. So definitely, I believe our portfolios need to be more balanced. The optimism we had 3 months back about next 2 years of growth story of India, definitely we need to balance our portfolios, and maybe from some cyclical sectors we need to go into defensive sectors. I'm not having any different prediction about when war will end and when commodity prices will go down. Frankly, no one knows. But I think even without the war, actually India's current account deficit, or how much we import versus how much we export, that equation was getting a bit adverse even before the Ukraine war. So if you see from around October 2021, our imports were outpacing our exports. So this trade deficit which we see per month was becoming high. Basically, imports being much higher than exports. So even at $85-90 of oil, that was becoming a bit of a challenge. And now 110, 115 of price of oil, it is definitely a big challenge. So yeah, I think we have to be a bit cautious on the economy, but my view on the market is slightly more positive than my view on the economy, because the reason, there are 2 3 reasons for this. One is 40 to 50% of our earnings are not related to India actually. So whether it is IT services, energy, metals, lot of exporters, um, and that part still seems to be doing well because overall global growth still remains okay. The second reason why I think market may do better than the economy is both globally and even in India, the return on fixed income is not going to be great. So already in US and Europe, we are seeing how bond market people are making big losses because the bond yields are going up. Even in India, I think the post-tax return on fixed deposit is obviously very low versus inflation. So in a period where there is high inflation, actually equities do well unless the inflation becomes out of control. So there is a phase of inflation which is actually good for equities, because what happened with equities is obviously it is reliant on corporate earnings, and corporates, once they get top line through a mix of real growth and inflation, they have a lot of fixed costs. So there is growth in profit to be sure, which is not there in fixed income by definition. So there can be big move from fixed income kind of product to equity kind of product. So I'm not so bearish on the market, but from the economy perspective, I think definitely challenges are there.
At least maybe for the next 1 or 2 years could be, no one knows.
Yeah. We don't know when the commodity prices will come down. And see, they should not come down because of a global recession or there is some crisis. Frankly, I am as scared of oil at $20 as at $110. So we need oil to be, I think, $50 to $80 is the kind of range we need oil to be.
Good. And so now one of the questions raised nowadays is say like is this becoming a new normal? Because in the last 20-30 years, we didn't see a calm nation being attacked by another nation. So we all thought that in general there won't be any more real wars, but there will be economic wars, even between US and China. That kind of it was more economic war, one taxing the other or increasing the excise duty, all those things. But now it seems that we are seeing a real war after so many years. And how do you view this, just from your personal perspective? How do you view this?
So I think there are two, three thoughts. One is we have to assume that the world is going to be what is called multipolar rather than unipolar. What I mean is unipolar is there is one big superpower, which was US, which was like the policeman of the world. So all the regions, basically the US, if you see, they had a naval presence in a lot of oceans, and they ensured that more or less all the regions were following a certain law and order types. Um, but now we have, as China has grown and Russia also has become more assertive, we are now, I think, in a more divided world where there is no superpower or policeman of the world kind of thing. And I think each region will have to think for itself, which could lead to overall defense spending globally also going up. Um, Second, unfortunately, the lesson can also be that a country should have nuclear power, because nuclear arms, because that seems to be the only big deterrent actually. If you don't have a nuclear weapon, it seems that you're open to being invaded. That is the
True.
second thought.
Even a country like North Korea, people are fearful.
Correct,
But
correct.
because they have some.
And Ukraine in mid-90s gave back all the nuclear weapons, and we are seeing what is happening. So yeah, I think that whole globalization phase we saw from 1990 to 2010 was the peak. Maybe 2020 was still that was a big trend, but definitely it looks like small regional agreements will become more important rather than uh, open supply chains, traversing every nook and corner of the globe. Because in even before the war, again, if you see, people were getting uncomfortable with chip shortage, people were getting uncomfortable with the fact that shipping containers had shortage. So the supply chains, which were, I think, very just in time, very finely balanced. Generally, I think there may be a move where people will have more inventory, more vendors closer, same maybe in the same country. So that whole thought process of just-in-time manufacturing, just-in-time inventory, and a global supply chain, I think there'll be a change in that thought process.
Earlier you told that probably you are bullish more on the markets than on the economy. And what is your thought process for the Indian economy? I mean Indian markets for the next 1 year, because investors are worried about the market than the economy, although it should be the vice versa thing. But so, what is your outlook for the next 1 year?
So I think we may discuss all kinds of macro, this and that, but finally markets will follow earnings. And one of the reasons I'm a bit more optimistic on the market is purely if you look at earnings. We had a good phase from 2002 to 2010, and then a very bad phase from 2010 to 2019. And the base of the earning therefore is very low, which is why I think even in a full COVID year like 2020, where there were a lot of lockdowns, you saw the listed companies EPS actually go up a bit. So I think the biggest part of the market is banks, and therefore their earnings outlook is important, and that part seems fairly safe, if we may call it that, in the sense that that whole credit quality issues are definitely going away. So a lot of the expenses in terms of credit cost or provisions for bad credit, that will come down over the next 2-3 years. And therefore bank profits, even if the economic growth was not great, so the bank profit should do well. And therefore, in general, we believe the lower price to book banks are better because see, growth we are not sure. So for high price to book, you need growth for the more expensive bank stocks. But for cheap bank stock, just the fact that asset quality or losses on bad assets that is reducing. And the last point on banks is also that, in fact, inflation is good for banks' asset quality because, see, if you have borrowed for a home, for a factory, for gold, etc., and the value of that asset has gone up because in inflation, obviously, the value of land, gold, plant, uh, house, everything goes up. So your anyone's tendency to default on a loan actually goes down because the amount of debt versus the value of the asset is obviously lesser. So definitely bank earnings look okay. Export earnings as of now, since the global economy is still okay, that looks okay. So a big part, maybe 40-50% is global driven, 30% is banks. So the earning part looks okay. So when we think about return, see, we are headed for a phase where globally interest rates are going up. So the price to earning multiple of the market can at best be stable, or it may come down also 5% or something, by 10% maybe. So we think earnings will grow high teens and returns on a 2-3 year basis will be low teens broadly. So that is the kind of, I know it is not a very glamorous return. It is not a multi-bagger kind of return. But I think that is how we are looking at it.
Okay, good. In that scenario, but now equity investments, equity mutual fund, if someone wants to invest, is it good to go bulk or more of a staggered approach, like next 6 months or 1 year, if the economy is may do well or may not do well, or interest rates may go up, all those things, all those uncertainties are there. Is it attractive to put one-time investments right now in pure equity funds?
No, I would suggest staggering is better because I just think this is a year of extreme volatility.
Okay.
So in fact, if you look at last 4-5 years, apart from March 2020, which was obviously a big fall and then recovery, but if you take those 2-3 months out, we have been living in a very low volatile kind of environment. But I think given that Fed and some of the other central banks seem to have fallen behind in terms of controlling inflation, now they're raising rates very fast. In terms of these commodity prices and these supply chain shortages. So I think overall, it is a kind of market where a lot of things can go here and there. So I think it is better to stagger the investment.
Okay. And probably over the next 6 months or a year or so?
Yeah, I think at least 12 months, I think volatility will be there because let's say, the tightening cycle of Fed has just started and they are expected to do a hike in interest rate almost every of the next 8-10 meetings. Until that happens, I think volatility will always be there because one will have some concern that because of rising interest rates, whether economy will go into recession or whether the demand for commodities will fall, etc. So in that sense, I think volatility should be high till at least 1 year.
Okay, good. That is on the short term. And for the long term, how do you view India as an investment destination? Because the last 10 years, US technology companies have given fabulous returns. I mean, much higher than India. So in the next decade, say most of the SAP investors or bulk investors who are coming youngsters, they don't need money right now. They need after 10 years, after 20 years, after 30. now how the markets will behave in the next 10 years. Will I make a very good profit, or will it be like past 10 years? So that is
The
the
last
question.
10 years also has not been bad for India investors. It
No,
will be
always.
like,
No, the investors compare US market, some other better market.
right, right,
So
right, right.
when compared to that, we are half, whatever maybe. So US market gave 20, 25 hours, gave 12, 13, 14. So that is the comparison they make. What do you think the outlook for next decade for India?
Whenever you say this, every year you get a disturbance, so sometimes you're being proved wrong. But if you seriously think about India from a 10-year perspective, I think there are a lot of things which are falling in place for India. So let's say in terms of manufacturing, for example, your biggest competitor, China, has both a cost issue that their labor costs are going up, pollution control costs are going up, and they're also geopolitically the equation with the Western world where most of the consumers are. That also is under stress. So India has a golden chance to become a manufacturing superpower. And in a sense, we need it because both from a demographic perspective of providing jobs and from the perspective that since we are importing energy and technology, so whether it is oil or coal or other commodities like edible oil, we are importing energy. And high-end planes, high-end auto, everything we import, which are very technology intensive. So since we, as a developing country, it is natural that high-tech things you will not produce yourself. But to counter those two big imports, you have IT services, which is more or less mature, but we need manufacturing to come up both from perspective of providing jobs and from balancing this import of big items. So from a geopolitical angle, India as a reliable supplier to any country, I think that positioning is very high potential and very, I should say, feasible right now. Now, if we are able to execute on that, and what do we need to execute on that is basically to build infrastructure, keep inflation low, etc., which has been happening to a large extent. Um, so I am very hopeful that we will take that place as the manufacturing and services export powerhouse of the world. Which naturally also, if you see, first Japan was there, then it became expensive, then South Korea came, then it became expensive, then from South Korea, China came. And I think if we are able to use our labor, which is cheaper, our infrastructure, which is improving, we should be able to write that natural succession of, the place to manufacture kind of thing for the world. Then we should be able to write that manufacturing and services export boom over the next 10 years.
Good, good. So you are more positive, I would say, and I am also very positive. I am always bullish on India. So as you said, in the last 10 years has not been that bad, except if you compare US technology companies.
Yeah.
And other than that, India was also good. So the next 10 years also, let us be hopeful that it will be a fantastic decade for India.
The last 10 years was good for consumption. I think the difference will be that the leaders of the next 10 years will be very different, I think, because consumption, to my mind, has taken India so far and it can't really lead the way forward. Because see, periodically, if you see last 10 years, because we were very heavy on consumption, we kept hitting problems of inflation and current account deficit. Because if you are consuming and not producing enough, you will have those issues. So to solve that, we need a phase of time where manufacturing and exports do well rather than consumption. So while last 10 years was also not bad, definitely, but I think the composition of growth next 10 years should be very different.
Now coming to the fund house, from the macro to the more on micro level, From as a fund house, as a Nippon India mutual fund, right now, where are you focusing? More on equity or hybrid funds or debt or other asset classes? Where do you focus right now?
So we are overall our strategy is to be the partner of choice for all major asset classes for both distributors and investors. So we definitely are looking at all the verticals, whether it is debt, equity, ETF, offshore, AIF, some part of real estate also in AIF, etc. So various segments we are focused, and we believe that we will be a kind of supermarket which will deliver good experience for the customer in multiple asset classes, multiple categories, multiple products. So overall, we want to kind of definitely grow faster than the industry.
Good, 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 good. And you are managing all the equity assets. In equity, within equity area, do you have a particular focus? Say, like, sometimes people are coming up flexi caps and say this is the going to be the next thing, or multi caps, and it's one solution for everyone, kind of multi cap
Right.
for the long term investors, or small cap, mid cap, whatever. Do you have a particular focus, or do you have a belief that this will be good for the investors? This category will be a better category for investors.
So at a particular point in time, one category or one style, I think can be good. So I'll answer it in two parts. So immediate from a tactical perspective, I think more than market cap or this thing, I think the value style, I think will outperform growth style. That is what I feel next, maybe 6 months, 12 months, 1 year, whatever.
Okay.
That is my view.
Okay.
But from the long-term perspective, see products. Some products will do well at some point. Some of the products will do well at some point. So our focus is basically two things. One is to attract and retain the best fund management and research talent in equities. And second is to have a proper risk management framework, because historically we have to admit that some of our funds have been very volatile. So we're trying to kind of have a robust risk management framework so that the performance is consistent across many years. So we are encouraging people, both internally employees and external customers and distributors, that our effort is basically somewhere between 3 to 7 year performance should be good. Because I think that is what is where fundamental investing works. And in equities, the time frame below that is very difficult to execute on equities if you're a fundamental investor, because a lot of your views may take time to play out. So whether it's 1 year, 2 year, 3 year, we don't know when some stocks will work. But definitely more than 5-7 years is not practical. I think people can't predict what will happen beyond 5-7 years.
True.
So our entire research process and risk management framework, we are trying to gear ourselves to provide a fairly solid and consistent performance in that time frame.
Okay. Good. And as I said earlier in the opening remarks, you are one of the funds that you are managing, Growth Fund, Nippon Growth Fund, has given phenomenal returns to the investors, 200 times. I often compare that fund with real estate and other investments. Has given phenomenal returns, 10 rupees becoming 2000 rupees and above, whatever. Now maybe a little less or low or high, I don't know. But the thing is, it's a phenomenal return for the investors. Similarly, the small cap fund that you launched, I think, if I'm right, 10 years ago, that has also done pretty well. And So can I say that you are a small cap, mid cap specialist fund house?
So as I said earlier, we want to be good everywhere. So even in
Okay.
large caps, we want to be good. Even in hybrid products, we want to be good.
Okay.
But also, we are passionate about mid and small cap. So in terms of research coverage, if you see, we are among the highest in terms of the number of stocks we cover. We cover more than 530 stocks, which is pretty large relative to any other AMC, most of the other names. And the reason you're correct that we have had a legacy of being known for stock picking in mid and small cap space. And that legacy is very valuable to us. We obviously feel very passionate about maintaining that legacy, and the performance of whether it's multi-cap, small cap, growth fund, which tend to have a lot of mid and small caps. We obviously like the track record we build, and we hope that our focus will be there on that space to generate, consistent outperformance in mid and small cap.
Good.
As an equity investor, it's a space which gives you a lot of kick.
True. When you get over a period of time, even the phenomenal returns these funds are given, mid and small cap. Of course, large caps are stable. Everything it should form part of one's allocation and all those things. But for very young investors who are looking, I would say like instead of going into crypto, probably people can get into small cap.
At least fundamentally, it's better, I think.
Yeah. Sounds good. Manish, in Nippon, you have made a lot of changes in the last few years from your investment process, investment thought process, whatever. Earlier, Reliance had its own thing, but subsequently with the Japanese coming in and their, nature of investment philosophy, things, everything are more detail oriented in general, which is attached to Japanese. How have this investment philosophy developed in the recent past, in the last couple of years? And if you can point out in a very simple language, layman's language, to our subscribers, it would be great.
Sure. So I think while we may have implemented a lot of processes, as you said, there are central philosophy. So I'll talk more about the central philosophy. One is that we want to be clear that, as I said, within that 3-7 year time, so everything is geared towards providing alpha in that time frame. Second is, I think it's very important to align research analysts and fund managers to the outcome. Basically, as they say, you should eat what you cook. So, see, in our business, a lot of subjective things can be talked about. But finally, I think we need to deliver alpha to or outperformance to our distributors and customers. So you need to be very focused on delivering that, and there should be incentives for analysts and fund managers to generate that outcome. So we have aligned a lot of incentives and the KPI of fund managers and analysts. We have perfectly aligned to outperformance in that 3-5 year kind of time frame. Third, as I said, also with help of our parent Nippon Life, because they have investments in asset managers globally, we have developed our own, and with Nippon Life, a lot of risk management systems that a fund. So we have, for example, concept of a fund casing, which is quite elaborate. So it is not just, let's say, what market cap ranges the fund can hold, but also things like active share, which is how much can the fund deviate from the benchmark, tracking error in terms of what are the returns historically versus the benchmark. Is it too wide of the benchmark? Quality of stocks. So we have an internal system to rate the quality of stocks, and we don't allow funds to have either very, very high quality in a very large proportion, or very, very low quality in a very large proportion versus the benchmark. So the point is that when you are having very, very high quality stocks versus the benchmark, it is also kind of macro call you're taking that growth will be low and cycle will be very depressed. When you have very low quality stocks, which are typically cyclical stocks, then you are saying that cycle will be very strong and growth will be very strong. Now, it is very difficult to forecast these things. So we essentially we want to move from macro level kind of positioning to bottom up stocks specific. So keep the sector deviations limited, keep the benchmark deviations limited, and look at generating alpha, with then will be more consistent and recurring.
Okay, okay, good. And from the sectors you are talking about, banking sector, and do you have some sectors on which you are very positive or on which you are negative?
So there are, I think, more of the cyclical sectors from a long-term basis are cheaper, although whether again they may not work in the short term if oil prices go up more. But from a 2-3 year perspective, we like the value banks, if I may call it that, where price to book is low. We like commercial vehicles because the cycle is beaten down. We like this theme of China plus one, while a lot of the stocks have played out. But I think in general, as I said, since we believe it needs to be the decade of manufacturing. So selective industrials or consumables in capital goods that we like. And I think this out of home consumption, again, some of the stocks have run up recently, but I think the top 10% households have a lot of spending power, which is not been exercised in the last 2 years. So whether it is multiplexes, hotels, beverages, typically the things you consume when you travel or go out and have events. So those are the kind of things we like at this point.
Okay, okay, sure. Then probably you are, value banks. That is one that you are pretty positive on, and some of the consumer staples and consumer items.
Not consumer staples so much. Basically, this outdoor consumption, what you do when you want to travel or
travel and leisure.
Consume outside. Because in COVID, all those industries got hit badly, whether it's hotels, beverages, etc. So those kind of things.
Okay. Before we have one or two questions before winding up. The thing is, your thoughts on interest rates. You told that probably interest rates will be moving up in the future, as the US has indicated and other governments have indicated. India might also be on its line. Will it have a negative impact on the economy?
So I think the risk is more in US and developed world, because see what has happened there is the gap between interest rates and inflation is very, very high. So whether you see US or UK today, the 10-year bond yield, let's say, versus the CPI, the consumer inflation index, it is almost like 300, 400 bips negative. That is, the consumer inflation is 300, 400 bips more than the 10-year bond yield. So there the catch-up has to be much more. India, roughly our inflation is 6, our 10-year bond is 6.8. So our 10-year bond yield is actually more than inflation, although historically that gap used to be higher, now it is less. And when globally interest rates are rising, maybe there will be some upward pressure on Indian interest rate because of that. But I don't think I don't think that we need to increase interest rates too much from here, because I think inflation, while today oil prices are high, so maybe 6.5 may happen, but assuming commodity prices within next 1-2 years come back to normal levels, So on inflation, I'm relatively more positive on India, US, etc. I think unfortunately they felt last year that it was transitory and they did not act from very low level of interest rates. Now the catch up has to be a bit more violent in that sense.
Okay, okay. Good. So India is in a better position comparatively. Yeah.
Yeah.
Okay. And Manish, your advice to retail investors at this point of time, anything specific?
So I think, see, last 2 years, the market has given good returns. So we should not be greedy and have very high return expectations, and we should not trade too much, etc. I think it is a market which will give steady returns to my mind. So our asset allocation discipline needs to be robust. We should, I think there is neither a case of being very low versus long-term allocation to equity, neither is there a case to be very high versus the long-term allocation one needs to have in equities. So we should just be disciplined and keep it around the long-term average. It may be a bit of a boring market, but I think it's not bad.
Okay. Good. That's good. And before to wind up, Manish, I know that you are not a very outspoken person. You are very calm, quiet. Even I have seen in your ICICI days everywhere. Just something about about you, which is personal, to share with our subscribers. It could be your hobbies, your family, the likes, dislikes, whatever you want to share. It's open to you.
Yeah. So, so I'm a Gemini, and generally it seems Geminis have hobbies or tastes which change a lot, which is actually true about me.
Okay.
So every year I do 2-3 things which I may not do next year or whatever.
Okay.
So this year I am doing long distance walks. I'm playing online chess. I'm into meditation a lot. So these are the things I'm doing. Following English Premier League in football.
Okay.
So
Good. Thanks, Manish. Thanks for sharing your knowledge, your views, your thought process with our subscribers. And I'm pretty sure that this is going to help a lot of amateur investors or people who want to know about equity investments or who want to know more about Nippon Mutual Fund as a fund house, because Nippon is one of the largest fund houses in the country today. And thanks for all the good job that you are doing over there, and benefiting a lot of Indians, the lakhs and lakhs of Indians who are benefiting out of fund house mutual fund industry, and in particular Nippon Mutual Fund. Keep up the good work, and whenever you are in Chennai nowadays, you can travel. So whenever you are in Chennai, let us catch up.
definitely.
Yeah? Thank you very much.
Namaste. And thanks for your very kind words.